Opendoor stock has had one of the most eventful weeks in recent memory. After a painful stretch where the stock sold off for 4 straight sessions, momentum has completely shifted. Wednesday's rally saw the stock surge more than 16%, and Thursday added another 10%, closing the regular session at $9.09 with an intraday high of $9.21. That's a massive 2-day swing, the kind of move that forces investors to pay attention. But what's especially interesting right now isn't just the recovery in price. It's the psychology of the market and, more specifically, the pressure building on shorts. For months, the short story has been part of Opendoor's narrative. Big institutional names like SquarePoint Ops, Group 1 Trading, Jane Street, and others were disclosed as having positions betting against the company. Add in individuals like Martin Shkreli publicly announcing his short entry around $9.36, and you've had a setup where short sellers have been part of the daily conversation around dollar open. Now, the story is turning. Let's start with the Jane Street development. Earlier this week, it was disclosed through a 13G filing that Jane Street Capital, one of the largest, most sophisticated quantitative trading firms in the world, had acquired a 5.9% stake in Opendoor, amounting to over 44 million shares. That is not a small position. This is a firm that handles about 10% of North American equity trades, that generated over $8 billion in net trading revenue in the first half of 2024, and that thrives on algorithmic, data-driven decision-making. For a firm like that to go long on Opendoor after previously being flagged as short is a major signal. It's not retail chatter. It's not hype. It's a cold, calculated, data-driven bet that the upside outweighs the downside. And the timing of that disclosure coincided with Opendoor's 2-day run back above $9. What does this mean for shorts still in the game? It means the tide may be turning against them. Think about the psychology here. If you were shorting this stock back when it was in the 7s, or maybe even when it was sliding under $10, you were betting on continued weakness. You were betting that the narrative around housing softness, higher rates, and company uncertainty would drive the stock lower. And for a while, that was the right call. The stock dipped hard, and shorts were comfortably in profit. But when Access Industries dumped 12 million shares and the market absorbed it, only for Jane Street to step in with a massive long position, the story changed. Suddenly, shorts who thought they were in safe territory now have to contend with one of the most powerful trading firms in the world positioning on the other side. That's not a small shift. That's a paradigm change. Now, add to that the fact that Martin Shkreli himself said he covered his short at $8.90 because he saw better opportunities elsewhere. That's another clue. Even someone who loudly announced his bearish stance has stepped out. The people left short now aren't the loud ones. They're the ones quietly holding onto positions, hoping this is just a temporary bounce. But what happens if Friday opens green? What happens if momentum builds again? Those shorts are under pressure, and the longer they hold without a breakdown, the greater the risk of a squeeze. And let's be clear, we're not talking about a GameStop-style squeeze here where retail alone drives an explosive move. We're talking about a company with real fundamentals, real institutional support, and a leadership reset that's creating catalysts week after week. Kaz Nejatian has already transformed the way Opendoor communicates and executes. He cut ties with PR agencies, promising to communicate directly through company channels. He accelerated the national rollout of Opendoor services, moving faster than anyone expected. His revamping pricing models, introducing internal AI tools like the Opendoor Assistant, and now he's teased a new product launch, likely in Texas, as early as next week. All of these things matter because they create a long-term growth story. And when you combine that with short-term market dynamics, like shorts under pressure, you've got fuel. That's the setup that makes Friday so intriguing. Now, let's dig deeper into why shorts are in a tougher position today than they were a week ago. 1. Momentum has flipped. Stocks move in waves, and psychology is a huge part of trading. After 4 straight red days, conviction among shorts was sky high. Retail was frustrated, and the open army felt like the wind had been knocked out of its sails. That was when shorts had the upper hand. But after 2 giant green sessions, the narrative is now about recovery, strength, and institutional buying. Shorts aren't operating from a position of confidence anymore. They're reacting. 2. Institutional positioning matters. Jane Street doesn't take large stakes casually. Their algorithms have pored over data, housing trends, transaction volumes, and stock flows. They've decided this is a trade worth making. And when someone with that kind of market-making power takes a long stake, it shifts dynamics for everyone else. 3. Macro conditions are improving. The Fed has already signaled the start of rate cuts. August housing data showed new home sales up more than 20% year-over-year, with median home prices holding strong. If housing remains resilient, Opendoor has tailwinds, not headwinds. Shorts betting on macro collapse are now betting against data. 4. Leadership is creating real catalysts. A potential new product launch in Texas, likely buyer-focused, could spark attention next week. Moving employees back to the office signals efficiency and accountability. Every step Kaz and Keith take reinforces the idea that this is not a company in retreat. It's a company resetting for growth. Add all of that together, and you have a scenario where shorts may have been comfortable a week ago, but today, they're squirming. Another thing to remember is valuation psychology. For weeks, investors debated whether Opendoor at $10 was a buy. Many were comfortable adding in that range, seeing long-term potential. Now, after the dip and recovery, the stock sits just above $9. The question is obvious. If you thought $10 was a bargain, isn't $9 an even better deal? That kind of thinking creates a floor under the stock. Long-term bulls see dips as opportunities. That makes life even harder for shorts, because every pullback risks being met with buying support. And retail conviction is no small factor. Eric Jackson, despite some recent controversy, remains long and vocal about Opendoor's potential. Keith Rabois has called sellers dumb money, making his conviction crystal clear. The open army has already proven it can withstand the toughest days. All of this reinforces the idea that bearish bets are running into a wall of belief and conviction. So, heading into Friday's pre-market, the angle is simple: shorts are under pressure, and the tide may be turning. We may not see an explosive move right away. Profit-taking could continue. Consolidation could play out. But the underlying story is this: the easy days for shorts are behind us. From here on, every incremental win for the company, every new product, every piece of bullish macro data, every institutional disclosure, makes it harder for shorts to justify staying in. And remember, it's not just about price. It's about time. Shorts pay to hold positions. They can't sit in them forever. The longer the stock consolidates above $9, the greater the temptation to cover and move on. That's why this moment is so pivotal. To the open army, the message is clear: you weathered the storm. You held through the hardest days. Now, the story is shifting in your favor. Shorts who were once confident are now looking over their shoulders. Institutions are stepping in. Leadership is moving fast. The housing market is providing support. This is how conviction pays off. So as we head into Friday, the setup is fascinating. Will shorts blink? Will we see covering drive the next leg up? Or will consolidation give bulls more time to reload before the next catalyst? Either way, the pressure is building, and it's not on longs. It's on the other side. That's why Friday's pre-market is less about fear and more about opportunity. Because when shorts are under pressure, every day becomes a test. And right now, Opendoor's long-term story looks stronger than ever. Onwards and up.